Welcome everyone to another episode of Financial 15. Kevin and I are going back to CPP, a very popular topic, one we get asked about quite a bit. And today we're looking at it from a different angle. If you retire early, what kind of impact will that have on your pension? Can it lower your CPP? We're going to answer that question. You want to stick around.
Yeah, beforehand, it used to always be mandatory. Everybody wanted to, or didn't want to go, but everybody went to 65. Nowadays, you got people retiring at 60, people retiring at 55. So we want to discuss some of that topic. Now, if you want to get this video or a lot of the other ones, please visit our YouTube channel and subscribe. Great content there. Lots of CPP information besides what we're going on with today. Or like us on Facebook. And most importantly, visit our website at beckerorr.com. There is plenty of information there on a variety of different topics that's going to help with your financial planning methods going forward. But today, as Clint mentioned, as opposed to taking it to the max, today we want to know if you're retiring early. Maybe you're retiring at 60. Maybe you're doing the 55. How is that going to affect my CPP going forward? Clint, let's get into this. What do we want to start with?
Yeah, well, we have to do a quick once-over of CPP so we have the context of how we're going to be making this decision. And of course, CPP, the basics, it's a pension in Canada. We've got a couple of big ones at the federal level. This is the one we all pay into. So if you see a deduction on your paycheck, likely going to be CPP. The other one is old age security, which we don't pay into. That's a video for another day. But today, CPP, you pay into it, you get something in the end. It's going to be a monthly taxable and fully indexed retirement pension paid for life. The amount you receive is going to be dependent on what you put in. The more you put in, the more you get out. These numbers do get adjusted every year. Right now, 2022, 5.7% of your income up to $64,900 goes into the plan. You make more than that, you've maxed out for the year, and that contribution gets matched. So you put in 5.7%, the employer puts in 5.7%. If you're self-employed, unfortunately, you're doing both halves, so it could be an 11.4% contribution there. There's a little more to go here with the basics. Kevin, why don't you walk us through it?
Yeah, basically, as we say, the normal starting age is 60. It doesn't have to, or 65, should I say? That's the normal starting age. You can take it early or you can take it late. Now, as we mentioned, maximal pensionable earning that you can get is $1,253.59 now, but that's not what majority of the people get. The average monthly at 65 is around $702, and it has to deal with a variety of different issues in regard to number of years you paid into it, how much you paid. And again, as we say, at 60, there's a penalty, which is 36%, depending on if you take it then. And you get a bonus if you delay to 70, at which point there's 42% more you can collect. And again, these are the things that we want to deal with as to when do we want to take it, early or late. So those are some of the basics that we want to know about CPP. And we've discussed this in many videos, which you can go and view on our website.
Oh, lots of them. We can give you like 15 different CPP videos if you're so inclined. The benefit and the bonus and the penalty, those are important metrics. But for our calculation here, we're going to go through more the CPP formula, how the dropout provision works, and how retirement early could be an item for that dropout provision. So let's focus on that. First, CPP, how do they determine how much you get? It's not exactly how it works, but it's kind of an average. You start at 18, you go to 65, they look at your pensionable earnings, they look at the amount you've been putting in, more or less an average. Not exactly how it works, but if you think about it in those terms, it'll make some sense. And this topic today about early retirement, you'll be able to interpret what we're going through here. If you want the exact formula, there's a good post by Doug Ronchi. He did this for the Retire Happy blog. You can see the whole URL in the banner there on the screen. You can go through it. It is a little more complicated, but if you actually want to make your own estimates and then get to the nitty gritty, that would be the place to go. But for today, keeping it high level, going through the dropout provision, how it could impact early retirement. So let's talk about all the ways they adjust that average, Kevin, to give you a little bit of a boost in your CPP benefit.
Yeah, exactly. And I mean, the contributory period, as you mentioned, is 18, basically until you retire. So if you collected 60, your contribution period is 42. If you collected 65, it's 47. If you go any further than that, you may get a few bonus. But if you go shorter, that's some of the things that you have to look at as to what 0 years we're going to get. Now, there are dropout provisions, child rearing years. You know, if you spent time out of the workforce caring for a child, those can be considered dropout. If you're collecting a CPP disability, years that you collect that disability are removed from your formula. And then, of course, there's the general dropout provision, which is 17% of however long you've worked. So as we say, at the age of 60, that's roughly 7 years. At the age of 65, that's roughly 8 years. Now, those are years that you can drop out of the formula that you do not have to calculate them in. So those are important to know as the dropout years. But again, the big scenario is, what's the contributory period that we have?
That's key, contributory period. So it starts at the age of 18, and then it goes until you collect. Keynote doesn't go until you retire. You retire at 57, your contributory period continues until you collect. Maybe that'll be 60, 61, everyone will be a little different. And then the dropout, that general provision, drops out the lowest years from the formula. Everyone's probably different, but I imagine your lowest contribution years, maybe you're different, Kevin. When I was 18, 19, 20, I probably wasn't contributing a whole lot to CPP.
No,
so likely those early years of your career are probably going to be dropped out of the formula, and then the latter years probably making a little more money, larger contributions. Those will be doing the heavier lifting for the CPP formula for most folks. Now we're going to go through an example to kind of bring this point home, because this dropout provision is key, especially if you're thinking about early retirement.
Yes.
Quick example here. Let's say we got Doug. He's born 1957. That means he's 65 in 2022. And based on his contributions, his dropout formula, he's getting pretty close to the max. We'll see he has $1,218.86. Now, I did a spreadsheet and with the help of Adam Buster, wealth and estate planning specialist, and we did the estimate. So it was based on our estimate. And the key here is, what if he didn't retire at 65? Instead of working all the way to 65 and then collecting it, we did another estimate here, Kevin, and I'll show you the number. You're going to be surprised, so get ready. Instead of collecting at 65, he retires at 55, and this is key. He doesn't collect until 65. So he retires at 55, but he says, you know what? I'm not taking my CPP till 65. I've got other sources of income here. I don't need it. So he retires at 55, still collects at 65. So the collection age is the same. That's key, because those penalties you mentioned earlier only kick in if you collect early. He's not doing that. So no penalty, just a period where he did not contribute. In this case, a 10-year period, a $400 per month difference. Look at that number, Kevin, $809.48. That is a remarkable difference because of that gap in the contribution years.
Well, yeah, and that's huge. I mean, that's the biggest thing. If we take a look at his 65 year, chances are, those 8 years that he had beforehand would be sort of that 18, maybe until 25. Yeah. When you aren't earning anything, he can eliminate those, at which point he's maximizing out everything else from there. Here, he has to count all those years in there, because between 55 and 65, it's a bunch of zeros. That's 10 years, and he can only eliminate 8 of those ones if he wants. So you're going to see a vast reduction. Now, maybe it's better if he takes it at 61 or 62, even with that sort of a clawback that you're going to get. But, that's something to calculate. Again, there can be a huge difference as to when you take it and how you retire. So if you retire early, don't expect that just because I retire at 55, I've maxed my contributions and I'm going to get that 1,200. No, because it's when you take it and how long between the retirement when you take it, that's a huge difference. And you're right, $400 can be significant when you're looking at that on a monthly basis. And for what, another 30 years beyond that? Large numbers.
Rest of your life. You're like $400 a month, but almost $5,000 a year for the hopefully a very long retirement period.
Exactly.
And again, just the formula to make sure this hits home. You've got 18 until you start collecting, not when you're retired. That's right. Until you start collecting. In this case, Doug collects at 65. And then he drops out the 70%, which is the lowest years, roughly the lowest 8 years in this case. But for every year, there's no contribution, which in his case is from 55 to 65. Every time he has one of those, well, that's a zero. That's going to eat up one of his dropout years, which means another lower earning year is going to be replacing it. So the formula is going to get a little lower on the average. You do have a number of those. In this case, he has 10 of them. His entire dropout provision will take 8 of them. He'll have 2 more zeros, plus all those other low earning years. Now his average goes down quite a bit, and you end up with a much lower benefit. Now, 10 can be extreme. Maybe someone retires at 57 and then collects at 60. Well, that's only 3 years. Maybe that's not as big of a hit. The idea here is this is something to consider, because you can't collect prior to 60. And if you retire too much before 60, you could have an extended period there of no contribution, which could go beyond your dropout provision, lower your average, end up with a much lower benefit. Now, it doesn't mean that's bad. Maybe that is a good fit for your situation. Maybe you plan for it and you know what? You're okay because you have other assets. You have other things that can help out in retirement. But the key here is you need to collect the data, Kevin, and then you got to have a plan, right? And the first step in collecting the data is that statement of contributions.
Yeah, you need to have that one. And as you mentioned, I mean, the biggest factor I think to take out of this is the fact it's the years that you've worked and then when you collected. When you collected is the big one. So knowing your statement of contributions is going to be huge. So if you want to do that at 55 and retire, it'll give you a listing there. But if you're not going to take till 65, those are things you have to consider going down the road. So getting your statement of contributions, it's definitely the place you want to do it. And where can you get it? My Services Canada account. That's the easiest place to go and get the information from here. And again, going online, as you've mentioned many times before, probably the easiest, unless you want to get stuck in voicemail jail for a number of hours or the rest of the day to try and get that information. So these are things that you can find out so that you can help in that retirement planning. And that's sort of an area that we want to get to as well. Once you've done these two, what's the most important thing we want to have, Clint?
You gotta have to have a plan, right? It has to fit with all the other parts of your financial puzzle. Make sure you can achieve your goals. This is only one piece. Of course, you want to make sure it's done correctly, but what is correct, what isn't correct will be dependent on the rest of your financial picture. So it all has to come together. That's the importance of the financial plan. You can't make these kind of decisions in isolation. And if you have questions, whether it's on CPP, on your financial plan, or really any other financial topic, we are happy to help out. You can always visit us, chatwithclintonandkevin.com. You can fill in the form. We'd love to hear from you. And we promise to get back to you quickly with an answer to your question. Anything you want to add to that, Kevin?
No, I think that covers the basics of it. We've now done later. We've now done earlier on CPP. Next topic's probably going to be somewhere in the middle of taking it right when I should. Things along that line. But otherwise, these are examples to take a look at. Make sure that you review your plan and make sure that you're good with your CPP going forward.
That sounds like a good place to end it. Everyone take care, stay safe. We'll be back again soon with another video.